The broadcast is now starting. All attendees are in listen-only mode.
Welcome to today's Energy Central webcast entitled ScottMadden's Energy Industry Update. Take it to the limit. A few housekeeping notes we'd like to mention. For best results in viewing this presentation, we recommend using a wired high-speed internet connection, as wireless connections can be unpredictable. If you cannot get adequate sound from your computer speakers, you may dial into the audio portion using the telephone number listed in the right-hand panel of your interface under the audio section. Following the presentation, we will have a brief question and answer period. You may submit your questions at any time using the interface on your screen. Now, I'd like to turn the floor over to our first panelist and our moderator, Kristen Lyons, who is partner and energy practice leader with Scott Madden. Kristen, welcome to the event. You have the floor.
Thank you very much, PJ. It's great to be here with you and the rest of our audience. Next slide, please. So for those of you who aren't familiar with Scott Madden, we're a general management consulting firm specializing in energy. We were founded in 1983, and we work across the energy ecosystem, providing services ranging from strategic planning to implementation support to expert witness testimony. Welcome to our webinar, Take It to the Limit. This is the theme of our Spring Energy Industry Update. We see the energy industry taking it to the limit in a lot of ways right now. We selected the theme of the EIU prior to the pandemic, and it's probably even more appropriate given what's happened in the last 3 months. As such, we're going to cover a couple of topics we wrote about in the EIU, and then spend some time on the regulatory strategies utilities are considering in light of COVID-19. So first, clean energy commitments. We're seeing a variety of states, individual companies, and utilities commit to 100% clean energy goals. This is one of the ways that the industry is taking it to the limit in terms of what we are asking the system that was actually designed to do something very different to do. Theo Tran, a manager in our energy practice, is going to talk about this transition. After that, we're going to talk about natural gas. We're seeing unprecedented supplies of natural gas right now at very low prices. But at the same time, we're seeing end-use customers walk away from natural gas and select regions, cities, states institute bans on its use. Jim Stevens, a partner in our regulatory practice, is going to discuss the future of natural gas utilities and some strategies they might consider in light of these trends. Last but not least, we have COVID-19, which is stressing our economy and energy companies in ways not seen before. Our clients are looking for both operational and regulatory levers that can be used to manage this crisis. And Greg Waller, a director in our regulatory practice, is going to speak to regulatory strategies that they might consider in light of this pandemic. So in all these ways, and many others, the industry is being taken to its limits. That's what we're here to talk about today. Our Director of Research, Greg Leitra, is going to moderate Q&A for the last 15 minutes or so. So we'll introduce him toward the end of our discussion today. And with that, I'm going to turn it over to Theo. Next slide, please.
Thanks, Kristen. All right, if you wouldn't mind going to the next slide. Thanks, CJ. Good afternoon, everyone. I'm happy to discuss with you all the latest trends in clean energy. And actually, before we dive into the current state of clean energy commitments, I'd like for us to take a look at the CO2 emissions landscape. We could go to the next slide. So what we see is that the CO2 emissions landscape has declined about 33% since peaking in 2007. And when we look at emissions by sector, that's electric power, transportation, residential, industrial, and commercial, what we see is that not only was electric power the largest source of carbon dioxide emissions until recently, it's also the sector that's driving the CO2 emissions decline in the US. And this is largely attributable to the transition from coal to natural gas and power generation. Another notable fact is that the decline in electric power sector emissions leaves the transportation sector as the largest source of CO2 emissions in the US. This sector is facing its own challenges with COVID-19's negative effect on public transportation usage, but this is its own case study, and we'll take a look now at the recent clean energy commitments. Next slide, please. So what we're seeing here is that 100% clean energy commitments have become more common. A growing number of states, utilities, end users have committed to a 100% clean energy goal. We'll take a look at where we see these commitments being made, as well as the breakdown of those commitments as a percentage of retail electricity sales. If we dive into geography, we find that these commitments are not isolated to just coastal regions. 8 states, Washington, D.C., Puerto Rico, passed legislation enacting 100% clean energy commitments, and more than a dozen electric utilities have made these commitments as well. And these commitments represent just a pretty significant portion of electric usage. The commitments from states, utilities, and also renewable portfolio standard requirements account for just over 43% of retail electricity sales. And that's looking at 2018 sales numbers. And for those of you who've already read through our energy industry update, you might notice that the 100% utility commitment portion has increased. And that's because Southern Company, which accounts for nearly 5% of retail electricity sales in the US, joined the growing list of utilities with clean energy commitments on May 27th. And they have a goal of net zero emissions by 2050. So while this list of utilities with commitments is growing, many of these commitments rely on a technology wedge, and that includes technology that's either not commercially available yet or has not even been proven yet. So we've also seen, unfortunately, that there's a recent International Energy Agency report which shows that the growth of low carbon energy and industrial technologies aren't on track under the sustainable development scenario. And this is aligned with the Paris climate deal. So there's still much work to be done in this area. So we've talked briefly about who's made commitments. Let's talk now about how they're going to get there. And to meet clean energy commitments, states, utilities can take various approaches. Let's go to the next slide. 100% clean energy commitments all share a common objective, and that's to remove CO2 emissions from operations. But they may utilize different approaches to reach the same goal. And these approaches include 100% renewable energy, 100% carbon free, and 100% net carbon neutral. The first approach, 100% renewable energy, utilizes only renewable resources, and this is the most challenging commitment to achieve, mostly because of the limited number of generation resources. We see this approach being adopted by a number of less populous states like Hawaii and Maine, and also by Washington, D.C. and Puerto Rico. The next approach, 100% carbon free, this includes nuclear energy among its resources, and it also significantly reduces the need for renewables in states or utilities with existing nuclear generation. And these commitments provide a strong rationale for renewing licenses of existing nuclear facilities. And lastly, the 100% net carbon neutral approach is the most flexible of the three. And this includes carbon capture as well as offsets, in addition to the renewable resources and nuclear energy. This is the common approach that most electric utilities take. And again, many of these utilities stress that new technologies will be needed to meet these commitments. All right, next slide, please. So while states and utilities are increasingly making clean energy pledges, they're also facing headwinds which provide uncertainty to the near-term outlook for these commitments. And as with other sectors, the full effects of COVID-19 on clean energy are still uncertain. Recent headlines have painted a number of pictures from the dramatic impact the pandemic has had on clean energy job losses to the positive long-term outlook for the clean energy sector. And unfortunately, the pandemic isn't the only headwind that clean energy commitments are facing. Recently, President Trump signed an executive order on securing the US bulk power system, and this tracks the assembly of products on the bulk power system. The utilities are still trying to understand whether renewables may be subject to this and are waiting on further guidance from the secretary. And so while the full effects of these headwinds are yet to be seen, we'll talk briefly about the trends that ScottMadden's monitoring as the industry responds to these challenging times. Okay, next slide, please. All right, so we'll focus on the impacts of COVID-19 on clean energy, and really these can be summed up in two words, delays and declines. The headline from earlier says it best: the energy transition will be shaped by the world's response to COVID-19. So let's take a look at the 6 trends we've been monitoring as the clean energy industry responds to these challenging times. The first trend is a decline in CO2 emissions, and it's no surprise that as people drastically reduce their travel, carbon emissions would reduce as well. And the fact of the matter is, though, unless there are policy changes, carbon emissions are likely going to quickly rebound as economies attempt to make up for lost time. The second trend we see is that there's going to be challenges to renewable energy project financing. A large question for renewable energy projects will be the availability of tax equity financing, which is the predominant vehicle for solar project financing. And with financial institutions looking to reduce liabilities, there's also likely to be less tax equity financing for solar projects. A third trend we're seeing is delays in renewable energy construction. It's still unclear how jurisdictions will treat renewable energy projects under construction. However, supply chain disruptions may also trigger delays due to a significant portion of that renewable energy supply chain being based in Asia. There is a bright outlook here, however, and at the end of May, the Treasury Department, as well as the IRS, extended deadlines for renewable energy projects that are eligible for tax credits as a result of the delays due to the coronavirus pandemic. Part of this extension provides projects with an additional year for completion and also with more time to meet a safe harbor requirement for starting construction. The fourth trend we see is around the potential loss of public policy momentum. Numerous states have increased renewable energy portfolio standards, or they've adopted 100% clean energy standards, but these legislative efforts may stall as lawmakers prioritize public health as well as economic responses. In a handful of states, however, we've actually seen regulators linking recovery efforts from the economic slowdown directly to existing or new clean energy commitments. We've seen commissioners in several states, including Arizona, California, Connecticut, Hawaii, and New York, issuing policy directives which affirm clean energy as a top priority. New York recently passed the Accelerated Renewable Energy Growth and Community Benefit Act earlier this year, and that streamlines siting for renewable energy projects across the state. We've also seen in California, the Public Utilities Commission issued a decision providing guidance to the state's load-serving entities to procure approximately double the amount of renewables and storage capacity that's currently online. The fifth trend we see is scrutiny around rate case proceedings. So a number of jurisdictions have frozen previously approved rate increases, and this could restrict grid edge investments like make-ready investments for electric vehicles. And the scale and timing of these investments may also receive closer scrutiny as PUCs consider how to mitigate economic impacts on customers. And then lastly, there's also going to be a declining customer willingness to make discretionary investments, which may impact residential solar and storage markets, and consumers may be less willing to pay a premium for electric vehicles. However, we have seen some action here too, and at the end of May, the New Jersey Board of Public Utilities unveiled the online application for phase 1 of their Charge Up New Jersey program, and this provides up to $5,000 as an incentive for the purchase of new light-duty plug-in electric vehicles. So while the short-term impacts of COVID-19 may paint a somewhat dreary picture, recent actions like states' affirmation of clean energy goals and incentives like those available through the Charge Up New Jersey program confirm the long-term growth potential of renewables. Can we go to the next slide, please? And so to recap on what we've talked about so far, the renewable energy industry must scale rapidly to meet the growing list of 100% clean energy commitments, and implementation and generation portfolios might vary depending on the type of commitment made. The near-term impacts of COVID-19 are marked by declines and delays, and the transition to clean energy will largely be shaped by how governments respond. And lastly, although clean energy commitments are facing other headwinds like the recent executive order, renewable technologies remain well positioned for the continued long-term growth. And with that, I will pass it back over to Kristen.
All right. Thanks very much, Theo. That was great. Next slide, please. So our next topic is the future of the gas utility, and Jim Stevens, a partner in our regulatory practice, is going to lead that discussion.
Thank you, Kristen. Next slide, please. There are three topics I would like to cover today. The first one, tailwinds and headwinds for natural gas markets. The second is regional aspects associated with natural gas markets. And lastly, I'd like to talk about some LDC strategies and programs to manage the tail and headwinds. Next slide, please. Any discussion of natural gas tailwinds starts with natural gas production. The left chart depicts actual and forecasted natural gas production. As shown by the chart, since 2005, natural gas production has increased by 70%, growing from 50 BCF a day to almost 85 BCF per day. On a forecast basis, supply is expected to grow by 40%, reaching 116 BCF by 2040. Over the 2005 to 2040 period, natural gas production increases by 134%. The right-hand chart shows the Henry Hub price. Since 2010, prices have ranged from $4.40 per MMBTU to a low of $2.50 per MMBTU. However, since 2015, prices have remained in a narrow bandwidth, ranging between $2 and $3. Lower and stable natural gas prices are driven by the significant increase in natural gas production, as shown in the left-hand chart. Next slide, please. Continuing with the tailwinds discussions, but focusing on a demand perspective. First, natural gas customers. Over the 2010 to 2018 period, natural gas customers have grown by 4.5 million, reaching 75 million customers in 2018. This is an increase of 6% over that time period, which is comparable to the growth in the US population. The right-hand chart depicts natural gas consumed by the power generation segment. Over the last 20 years, demand from this segment has doubled from 14 BCF a day to 31 BCF a day. Whether reviewing production, pricing, natural gas customer growth, or demand in the power generation segment, there have been various tailwinds to support natural gas growth. Next slide, please. Next, I'd like to turn to natural gas headwinds. Over the past year or so, cities and towns in certain states have either proposed or passed natural gas bans as a way to achieve GHG targets. There have been a variety of approaches to these bans. Some focus on town buildings, such as Seattle. Others use a size metric, such as Berkeley and San Francisco, number of stories or square footage. Still others focus on new buildings, such as the city of Cambridge. Also, some towns have outlined exclusions to the bans, such as natural gas cooking. In response, and more recently, certain states, as shown by purple in the map, have passed or proposed measures that limit the ability of towns in those states to ban natural gas at the local level. The stated goals of these state policies are to, one, avoid a patchwork of local rules with different approaches. Two, provide consistent timing and direction regarding GHG targets. And lastly, place the fuel decision with the end users. In the orange box on the bottom right-hand side, certain LDCs have imposed limits on customer growth due to the timing in process of adding additional natural gas resources. Regardless of the local approach or the reactions by states via policies, natural gas is facing certain headwinds. Next slide, please. Prior to discussing LDC actions to address tail and headwinds, I would like to note the regional aspects of natural gas markets, which reflect customer demands, weather patterns, and usage profiles, as well as access to natural gas supply, pipeline capacity, and on-system resources. I will use prices to show these differences. On this slide, I depict on the top left, the Northeast market, on the top right, the West market, bottom left, Texas, and bottom right, the Midwest. First, I want to focus on the scale of the various price charts as a sign of the regional differences. Starting with the Northeast, there's a price spike of almost $90 per MMBTU in numerous data points above $10. In the West, there's a price spike of $40 per MMBTU, also numerous data points above $10. On the bottom left, which is the Texas price signal, all data points are below $10. In fact, some data points have negative values. In the Midwest, all data points are also below $10, and over the last 2 years, prices have been below $3. Also, the shape of the price curve is also a signal of the differences across regions. For example, in the Northeast and Midwest, you can see seasonal weather changes and associated price spikes. Next, in the SoCal Citygate price index, there is a significant change, approximately 2016, reflecting an on-system storage asset that came out of service, and you can see the volatility associated post that on-system asset coming out of service. Lastly, at the Waha hub or the Texas price, increasing supply with limited takeaway pipeline capacity resulted in a marketplace where prices went negative. The difference in price signals reflect the regional aspects of markets. Next slide, please. In addition to regional supply and demand issues discussed on the prior slide, residential prices also reflect state regulatory policies. Differences across regions or states are shown by the map, with residential prices ranging from a low of $7 to $9 range, while other states are twice that at $15. As mentioned, regional markets reflect first demand, customer segments, pace of growth, weather changes or patterns. 2, access to supply, pipeline availability, other on-system assets and resources. And 3, regulatory policies, DSM programs, cost recovery, rate design. The difference across regions and states frames LDC actions to manage tail and headwinds. Some approaches will be more relevant depending on the region or state the LDC provides service in. Next slide, please. Based on tail and headwinds discussed and the regional aspects of natural gas markets, there are certain activities that can be expanded and other activities that can be developed. I provide this list to show the range of options available to LDCs. There are increasing opportunities to understand localized demand trends, load pockets, and shape of growth. The availability of data supports this analysis. Use established frameworks such as DSM and energy efficiency, but increase the activity, dollars spent, and breadth of those programs. Provide services and price signals that allow customers more control over usage. Develop products that support carbon reduction, such as green tariffs, where customers pay more for service, and outline transparent processes for developers of green projects in order to connect to the LDC system. Turning to gas supply planning. Use existing or standard planning metrics, such as design day or design year, but consider adding cold snap, as timing and intensity of weather patterns matter in terms of gas supply portfolio performance. Develop a portfolio that has more flexibility and options, more tools to manage change. Stress test the portfolio. Understand your risks and exposures. Lastly, as demand forecast becomes more locational, assess a wide range of options available to meet that locational demand. Perhaps supply side option, demand side option, upstream, on system. Just consider a wider variety of options to meet your more localized demand. Next slide, please. Next, I'd like to focus on actions that support the reductions of GHGs. LDCs and states have well-established and funded programs to replace pipeline that is more leak-prone. Continue, perhaps accelerate these programs where possible. Measure, develop scorecards. Develop your GHG baseline, and where possible, measure and quantify components of GHG. Track and communicate your progress. Utilize available resources. Benchmark your practices to others. Develop peer groups to share your learnings and learn from them. Join established trade groups and that are conducting research focusing on GHG management. Develop an internal team to study longer-term, more aggressive options to lower carbon content, such as blending hydrogen. Lastly, I would like to focus on the benefits of RNG projects as an approach to reduce carbon content in the gas stream. Local on-system projects would reduce or postpone upstream contracting and provide local construction, local jobs, investment in the community. RNG projects also diversify the gas supply portfolio, providing another on-system asset for the LDC to dispatch. Lastly, there have been various regulatory approaches used to approve RNG projects, such as volume targets, cost of gas budgets, or submitting one contract at a time for approval. Next slide, please. In terms of recap, the first takeaway I would like to provide is that LDCs are benefiting from strong tailwinds such as production, customer growth, the need to manage the headwinds of evolving expectations regarding carbon. 2, regional context matters. Need to evaluate your options through this lens. And lastly, there are a wide range of options available to LDCs, but approaches will reflect your particular circumstances and situation. Thank you. Kristen, back to you.
Thank you, Jim. Next slide, please. Last but not least, Greg Waller is going to talk about regulatory strategy under the effects of COVID-19. Greg?
Okay, thank you, Kristen. As Kristen said, I'm going to talk about regulatory issues surrounding the pandemic and then talk about some regulatory strategies that can help us come out of this pandemic. So if we start with the next slide, I'd like to start out just by going over a little bit about where we are now and how we got here. I personally point to March 12th as the key date. I was in the car heading home from a nice spring break trip with my family and felt as if the economy was literally shutting down around us as we were making our way home. And while non-essential businesses were in fact shutting down, essential businesses, including utilities, of course, were scrambling, trying to figure out how to keep employees and customers safe while still providing the reliable service that everybody is more dependent on now than any time. And the other thing we saw in March was immediate financial relief for customers in the form of almost universal moratoriums on disconnects and late fees. And we'll talk about more of that in a second. As we get into April, I will argue that we did a pretty decent job as a society sheltering in place, trying to do the right thing. Everyone, including utilities, were trying to figure out if working from home was going to be truly viable or not. And a lot of utilities took a strong look at their liquidity position. And in fact, many utilities in late March and April went to the debt market to shore up their balance sheet. And it was unfortunately not particularly cheap to do so as spreads widened, but it was a prudent move in most cases. The other thing we saw in April were the beginnings of these cost tracking and deferral orders that we'll talk about here in just a second. And as we get into late April and May, we arrive at earnings season in the United States. And what we found was that most utilities, well, there were a few exceptions, most utilities were unwilling to change guidance that they had previously communicated. They simply stated that it was too early to truly understand the depth or length of the impact. And so most stuck with their earnings guidance and notably their CapEx guidance that they had previously communicated. And most, again, provided very cautious statements and lots of caveats. So it tells me that when we look at the second quarter earnings calls, it's going to be really notable to see how or if the situation has changed by then. The other thing in May is, of course, we realize as regulated businesses, utilities, the recovery is going to involve a filing in some form or fashion, a filing with regulators. And so when to make that filing and what to put in that filing is a critical part of the strategy. So it's important to be prepared for that as we get into June. And you know, it's still to be determined how June is going to play out, but as we continue to try to reopen, deal with a potential second wave or a continuation of the first wave, whatever you want to call it, being prepared to make that filing or execute that strategy that hopefully has been worked on through May will be important as part of the recovery. So if we go to the next slide. As I mentioned earlier, the initial reactions to the pandemic were very predictably customer focused. And they were initiated by regulators and utilities and came in the form of disconnect and late fee moratoriums, broadening of payment arrangements, looking for any source of assistance funds to help customers pay their bills, and has been mentioned before, temporary suspension of rate increases in some cases. These were voluntary by utilities. In other cases, they were simply logistical in nature as commissions were trying to figure out how or if they could hold virtual hearings. As we transition a little further down the road, we saw regulators begin to issue accounting mechanisms to allow utilities to defer expenses that were directly related to the pandemic off of their income statement onto their balance sheet. And if this financial concept sounds familiar, it should sound familiar. It's exactly the same financial concept that existed coming out of the Tax Cut and Jobs Act of 2017. The direction, of course, here is opposite. With the Tax Act, it was a large decrease in expense to utilities. Here we have an increase in expense to utilities. But again, the financial concept of deferring that off of the income statement and putting it on the balance sheet for future consideration is the same. So we begin to hear from commissions reiterating that really nobody benefits from a financially stressed utility. Certainly not customers, employees, regulators themselves, and even debt holders and shareholders. In today's society, utilities are critical and nobody benefits when one is financially stressed. So we're up to 21 states that have accounting orders in place already. Roughly a dozen more have certain similar type cases pending. And so we've also gotten to the point now where many have already begun trying to figure out how they're going to end the moratoriums and how to deal with, you know, when and if to end those moratoriums and how to deal with the bad debt that has resulted. We did hear fairly recently on a webinar from one commissioner in particular. Others have said similar things, but notably Commissioner Presley in Mississippi, who also happens to be the president of NARUC, reminded everybody that these bills, you know, will be due. This is not a permanent holiday for ratepayers. The bills will become due, and again, dealing with that is going to be important. The last thing I just wanted to mention as it relates to these accounting orders is recognizing that while they are helpful for the income statement, they do very little to support cash flow. In order to support cash flow, it still involves a filing of some sort and an actual change in rates. So That's going to be important, and we'll talk about that in a minute. As we go to the next slide, things to continue to focus on now. The reason I say continue to focus on is because most utilities have done a fantastic job of getting down this path. Number one, as always, is take care of people. You have to focus on the safety of employees and customers, but also don't forget about regulators. Be attentive to regulators' needs, be helpful, communicate, provide ideas, but also don't be afraid to ask regulators for help if you get into a situation where you need help and their support. As far as operations, again, it comes down to safe and reliable service without exception is absolutely critical. Watching out for new threats. So not only are we dealing with the current pandemic, but we're also, this time of year, as an industry, always looking out for storm season, fire season. In this case, it's on top of the existing pandemic. And then finally, in this section, keeping investment activity on track is important. As we heard a couple of slides ago, most utilities committed to their investment activity staying on track, and that's going to be very important as we understand that there's there's finite capacity for contractors in the country. So the idea that a utility is going to be able to delay capital spending and catch it up later is going to be very difficult given the already somewhat constrained contractor capacity in the country. Tracking items for recovery simply boils down to following whatever accounting order you have in place in your state or your jurisdiction, and tracking expenses, revenues, and CapEx that are related to the pandemic and incremental to base rates. And developing the regulatory strategy, again, comes down to basically two things: when to file and what to put in that filing. We'll talk about that on the next slide. And then finally, preparing for the next disruption simply says that there's things we can advocate for now and try to get in place now, certain regulatory features that if we get them in place will help us prepare for the next disruption and minimize its impacts. So if we look at the next slide, talking about that next filing, so when to file that next filing basically begins with what is your current situation. If you're a utility that is subject to an existing annual mechanism or formula rate plan or have an infrastructure rider in place, my suggestion is it's best to stay the course and file as required by tariff. All of those tariffs, or most of them anyway, have date certain filing dates in the tariff. Let the mechanism work as intended, and a lot of the recovery will take care of itself. Of course, you still have to be sensitive to regulators' preferences if they need you to delay or again, for logistical reasons, require delay. And if you don't have a comprehensive annual mechanism, if it's more of just an infrastructure rider, developing a strategy to eventually recover those costs that are not covered by the rider is going to be important. If you're in a pending general case, so this is a case that likely started before the pandemic, again, I would recommend following the procedural schedule if at all possible, but be flexible to change if necessary. You can start to incorporate COVID-19 costs if that's possible, if it's early enough in the cycle, but also be prepared to wait till the next case to get those. And then finally, if you have no pending case at all, really it comes down to the decision to file, and things driving that decision to file will include things such as your current rate design, your current geography, when was the last time you had a rate change, so forth like that. That boils down to your current risk and financial position. As far as what to put in that filing, when you make it, billing determinants, class cost of service studies are going to be critically important as billing determinants move around among the various customer classes. And we try to figure out, which of those movements are going to be permanent in nature and which are just simply temporary in nature. An ROE update will be important as, of course, everybody understands that the world, including for utilities, is riskier now than it used to be. And finally, again, recovering that reg asset for COVID-19 if applicable. As we look at then regulatory features that can be put in place now that'll help prepare for the next disruption, we'll look at the next slide and cover those. So these include rate design. For rate design, we're looking towards a bias towards higher base charges, or really anything that will decouple revenues from usage. Formula rates or multi-year rate plans simply recognizes that rates need to change annually to ensure that billing rates reflect underlying costs. And this can be done in a number of ways. It can be done through a streamlined annual mechanism that I mentioned earlier, or a multi-year plan that has provisions for annual rate changes. The reason I prefer annual mechanisms, and specifically comprehensive type annual mechanisms, it takes the emotion out of the decision to file. As everybody's aware, making a decision to file for a rate change, which again in this context is likely a rate increase, given all that's going on, can be a very tough decision. And so if you have an annual mechanism that has dates in the tariff that require you to file on a particular date, it just simply takes the emotion out of that decision for everyone. Eliminating regulatory lag boils down to recognizing, number one, that regulatory lag results in a permanent loss of prudently incurred investment expense, and therefore is the primary hurdle to not being able to earn an authorized ROE if you are a utility investing at a rate that's a multiple of depreciation expense. So dealing with lag should be high on everyone's list anytime, and especially now. Cash flow, there's several mechanisms that have gotten more popular over the last 10 years or so that allow partial recovery of some expenses, particularly bad debt, which is very appropriate for this day and age. They allow partial recovery of bad debt expense outside of base rates. So that can support cash flows even in situations where your expenses are lagged within the base rate context. Advocating for a strong balance sheet will put downward pressure on debt costs, and also, of course, provide stability to help ride out a long disruption period whenever the next one happens. And then finally, reciprocity simply means taking the opportunity to write into either tariffs or settlement agreements today the ability to, or the assurance that the costs will be treated fairly regardless of which direction they go. Several utilities took advantage of this, again, coming out of the Tax Cut and Jobs Act, in anticipation of tax rates going back up someday, writing into their settlement agreements that, we will deal with the expenses now this way, but ensure that when rates go back up, we'll also deal with them fairly when they go the other direction. So, all of these things take time, takes obviously collaboration with regulators, and recognize that incremental progress is okay. Again, some of these will take multiple filings and a lot of education and work to achieve. And so making incremental progress is fine. As we go to the next slide, so again, key takeaways. Number one always has to be take care of business, prioritize the safety of customers and employees, and provide uninterrupted, safe, and reliable service. Number two is develop a regulatory strategy that focuses on that next filing so that you're ready and prepared to execute that filing whenever the opportunity presents itself. And then third, within that filing, emphasizing regulatory features that reduce lag, stabilize revenues, and support cash flow that will help now and help prepare you for the next disruption. And so with that, I'll pass it back to you, Kristen. Thank you.
Thanks very much, Greg. So I'm now going to turn it over to our Director of Research, Greg Litra, who will handle Q&A. Greg?
Thanks, Kristen. And we do have a few questions that have come in. So it's in no particular order, so I'll start off with a question addressed to Theo. Theo, part of the clean energy commitments include energy efficiency measures. Question here is, what impacts, if any, do you see of COVID-19 having on the energy efficiency sector?
Yeah, thanks, Greg. Well, what we see, unfortunately, is that the energy efficiency sector has seen a great number of job losses, particularly in the clean energy industry. So I think the last number I saw was around 70% of jobs were lost. And if we think about the nature of energy efficiency work, that figure makes sense. It's impossible to install energy efficiency measures under social distancing or the recent stay-at-home orders. But the encouraging thing is we we do see the energy efficiency industry adapting to these situations. So we've heard of utilities using technology to drive projects forward, and that could include anything from conducting virtual assessments, shifting over to instant contact-free rebates, and also relying more heavily on digital marketing. So as we're kind of sussing out how to react to this new normal, customers are also going to have new priorities as well. We might see customers shift towards technologies that are more health related, and if we think about measures that tackle indoor air quality, for example. And we also might see greater focus on tests that have been historically not valued by the market, things like societal tests when looking at various programs to implement.
Thanks, Theo. Appreciate that. Second question is for Jim Stevens. Jim says, you discussed green tariffs to support renewable natural gas investments. Could you provide more detail regarding those tariff approaches?
Thanks, Greg. Sure. Green tariffs generally allow a customer to choose a level of support for green projects. For example, a customer may elect to pay an RNG surcharge on a certain percentage of its volume. Another approach, the utility may charge the customer that's in that program a fixed charge. Also, it's important to note that programs usually allow the customer to opt in or opt out on a monthly basis. On the supply side, one approach to support RNG development is to provide the LDC with a budget or volume target in terms of how to contract for RNG. So, for example, if it's subject to a budget cap, 5% of the revenue associated with collections may be allowed to be spent on RNG projects. If it's a volume target, perhaps 3% of the gas sold will be allowed to consist of RNG projects. In this way, by setting a volume target or a budget target, you avoid the need to come in on a contract-by-contract basis for regulatory approval. Thank you.
Thanks, Jim. Next question is for Greg Waller. During your presentation, Greg, you stressed, quote, safe and reliable service. Why is that such a focus?
Sure. It simply comes down to this. I think nothing, in my experience, nothing can derail a good regulatory strategy or outcome more quickly than a safety-related incident or a customer service failure. Like I said, it's just as simple as that. And unfortunately, this is one of the items in the world of rate making that's usually not reciprocal. In other words, superior operations or customer service certainly can help and can facilitate a regulatory process. But unfortunately, it doesn't usually help as much as a failure hurts. A failure can derail a good strategy very swiftly, unfortunately.
Thanks, Greg. And another question for you. What exactly do you mean when you say lag causes some prudently incurred investment costs to be never recovered or permanently lost?
Sure. It simply recognizes that when you have an investment that is lagged, subject to regulatory lag, it means the investment is partially depreciated by the time it's reflected in rates. And so when you make an investment that is partially depreciated before it gets reflected in rates, the utility loses two key pieces of cost recovery. It loses the return on the depreciated portion of the investment, so the amount of the investment that was lost before it was reflected in rates, the return on that investment is never recovered. And then just as bad, if not worse, is the return of the investment. So that's the depreciation expense itself that was recorded prior to the investment being reflected in rates. That expense is also never recovered. So if you think about it like this, if you invest $1,000 and it's lagged to where it's depreciated to $900 by the time it's reflected in rates, it's putting $1,000 in, getting $900 back, and losing the return or the interest, if you will, on that $100 at the same time.
Thanks, Greg. Next question is for Theo. Theo, you mentioned the potential impact of the President's executive order on clean energy. And questions come in. Could you elaborate on that?
Yeah, thanks, Greg. So the executive order that we referenced earlier, that was signed on May 1st. And this really applies to transactions that involve a wide range of equipment used in bulk power systems. So not only in substations, but in control rooms or power generating stations as well. And some of these may be incorporated in utility scale renewables projects. So the general interpretation these days is that it's directed at the electric transmission system operations, but language appears broad enough to include some activities of those utility scale renewable energy developers. So there is the possibility that a rip and replace might be mandated to address the concerns of this order. But the reality is the Secretary has until September 28th to communicate the rules and the regulations required to implement this order. And really it's the industry is in a wait and see mode to see what further clarity is going to come out when those rules are publicized.
Thanks, Theo. Next question is for Jim. Jim, you had mentioned the possible role of RNG in the future resource mix. What are the typical issues addressed when a gas LDC submits to its commission an RNG contract for approval?
Thanks, Greg. So there are various components likely included in an RNG contract filing. One is the description of the project itself, location on the system, expected volume of supply, in-service date, and term of contract, length of the contract. Then there'll be a cost-benefit analysis. Is the supply in-state? What are the economic benefits associated with a local project development? Benefit of reduction in carbon, benefits of the portfolio by including the new contract, and also a cost metric, total cost and unit cost impact of the new project. Lastly, you're requesting pre-approval of the costs, and so you also include how the costs will be recovered and over what time period. Thanks, Greg.
Thank you, Jim. Next question is for Greg Waller. How do you go about asking for and ultimately getting regulatory features like rate design or annual rate making and lag reduction in jurisdictions with clear precedent or even statutes that are in contradiction of what you want?
Sure. So there's several, I guess, ways to handle that question. As I mentioned before, number one is education and collaboration with regulators. It can also be working with peers. If you're in a state with a number of peer utilities, doing that education and collaboration with regulators as a group of utilities is often useful and can work well. Working within existing parameters is always probably usually the easiest way to go about it. So an example of that is with lag. We recognize that regulatory lag is very detrimental to the health of a utility, and that can be, for example, handled in one of two ways. It's typically handled with forward-looking test years is the most direct way to handle regulatory lag. But if you're in a state that is very much tied to the precedent of historic test years, for example, working within that parameter is fine. We have ways that you can eliminate lag even in states with historic test years. So to the extent you can make something work and get ultimately what you'd like as far as a regulatory feature without having to to violate or change existing precedent, that's usually the smoother path. And as I said before, making incremental progress is okay, but being persistent is required as well. So you have to keep after it, and it may be multiple iterations, multiple filings, and quite frankly, a lot of hard work to get there. But the end result's usually worth it.
Thanks, Greg. Next question is for Theo. Can you dive a little deeper as to what is driving 100% renewable energy commitments from utilities outside of 100% renewable portfolio standard states?
Sure, good question. So we see there's a number of drivers that's driving these 100% renewable energy commitments. I think one of the first obvious ones is the strong and growing customer interest in renewables and climate change. And we see this not only in the utility sector, right? I think we see a lot of consumers are starting to apply pressure to corporations along these fronts. So that's certainly a driver there. Another driver is that these utilities, there's a desire to be more proactive instead of reactive. So being able to control the future and what their goals and commitments are instead of responding to requirements. It's much easier to be part of that planning than just to react to what's applied to you from a requirements perspective. We also see there's an increase in focus on utility scale over distributed renewables. And lastly, just resource availability, right? So wind is plentiful in Minnesota and solar is plentiful in the Southeast, and with the lower cost of technology these days, it just makes sense to further these commitments to the 100% renewable energy.
Thanks, Theo. I think we have time for one more, and the last one here is for Jim. Jim, do you see any changes in the industry that would change the direction of flows on the pipelines in your future?
Thanks, Greg. Typically, pipeline flows or pipeline development will follow either changes in natural gas supply or changes in natural gas demand. For example, the development of the Marcellus and Utica supply basin, which was in a market area, significantly impacted flows on existing pipelines and resulted in development of brand new pipelines. A demand side example is the expansion of the LNG export market in the Texas-Louisiana area. Because of that expansion, there's been significant investment in new pipeline projects, as well as a changing flow pattern on some pipelines to bring feedstock to those LNG export facilities. So in the future, if there are additional changes in supply and demand, I would anticipate significant changes in pipeline flows and development as well. Thanks, Greg.
Thanks, Jim. Appreciate it. Kristen, back to you.
We're just about at time. Thank you. Next slide, please. So thank you very much to our presenters today, and thank you all to the audience for joining us. All the materials from this webinar will be made available. We also encourage you to visit our website at ScottMadden.com for additional insights both on the industry and on COVID-19 and how it's impacting electric and gas. So again, thank you very much. And back to you, PJ.
Thank you, Kristen, and thank you, presenters. Fantastic presentation today. For our audience, we hope you've enjoyed today's discussion. As you log off, please take a moment to complete our survey and give us your feedback so that we can continue to provide you with quality content. Thank you for attending. This concludes today's presentation.